Joining us once again, Kim Anderson, our grain marketing specialist. Kim, this week we saw Kansas City wheat drop below that support price at $6.36. Where's it going from here?
Well, we're going to watch that. It tried to come up just a little bit at the end of the week. It's setting around 620, 625, somewhere in that vicinity. If it can pop back through that 636, which I'd give it about a 40% chance of doing that in the next couple of weeks, then we'll take a run back up at that 660. I think that it will probably go down and challenge the $6 to $6.05 level on that Kansas City September contract. Challenge that. If it breaks it, then it's Katie bar the door. It's probably going to go down to 570, 575.
All right, now we've talked about a few factors contributing, but what's really driving this drop in prices? Is it our stock situation here in the U.S. or just really good looking foreign crops?
Well, our stocks here in the U.S. are Jekyll and Hyde. You look at hard red winter wheat stocks, they're very tight, as you would guess, with the short crop that we just had. But you've got above average stocks we're expecting that for the hard red spring wheat. We're expecting above average for the soft red winter wheat. U.S. just right near average. You look at world ending stocks, they're projected to increase this next year. You look at just about every major exporting country, their ending stocks are increasing. So what we got is tight hard red winter wheat stocks, and not excess, but more than adequate wheat by the other varieties in the U.S. and countries in the world.
All right. Now, Kim, we would hope at this point that a producer still holding on to their wheat can afford to do that for a while. And is that really the strategy here, just to hold your wheat and kind of wait out these prices?
Well, if they're still owning wheat, of course, the strategy should be a third, a third, and a third. If they haven't sold any, I would suggest they sell some wheat. If they hold it, I think they're looking at a maybe 60-cent downside risk. If they're holding it, downside lower price. If they're selling it, I think they're giving up the potential for maybe a 40 or 50-cent price increase. So that's their risk. 60 down, I think 40 or 50 up.
All right, now to change gears a little bit, next week you'll be at Canola College, Tuesday in Enid and Wednesday in Altus. Give us kind of a preview of what you're going to be talking about, and really let's talk about the profitability of rotating canola and wheat.
Well, we're going to talk about world canola production, where it's produced, and what the price is probably going to do over the next year. Let's concentrate right now on comparing, say, just producing wheat. Look at a wheat canola rotation. The estimates that Eric DeVeest gave me was $71 for wheat only, that's Central Oklahoma. If you do a wheat canola rotation, you're looking at $104 above your variable cost. Southwest, $23 for wheat and $54 for the wheat canola rotation.
So it really does make some sense then.
You bet.
All right, Kim Anderson, grain marketing specialist here at Oklahoma State University.